Well, welcome to Chapter 5, where we'll recap some capital cost allowance discussions and touch on a few extra points. It's important to remember that under the Income Tax Act, Section 18 and 20, it talks about capital costs not being allowed to be deducted. However, adds the fact that you can add capital cost allowance, which is amortizing or depreciating the assets over the estimated life of those assets to incur an expense against earned income. Some key things to consider is that terminology is relatively similar as far as what the different components are. So capital cost allowance is pretty much the same as amortization and depreciation. They can be different rates, accounting policy for amortization versus tax policy for depreciation or capital cost allowance on those said asset classes. Capital costs and costs are one and the same. UCC, which is the undepreciated capital cost, is comparable to the net book value, again with some timing differences based on your accounting principles versus what's allowed for tax purposes. When it comes to additions of capital assets under accounting, very often you track by individual assets. However, on income tax, it's very much by aggregated classes. However, there are times that you'll need to track some individual capital costs, especially when you're dealing with dispositions. When it comes to write-offs in tax versus accounting, under the accounting methodology, there's a variety of methods. Straight line, useful life, it can be per widget, can be declining balance, etc. And it's typically applied consistently. So under accounting principles, you would have one accounting policy for a type of asset, and you would apply it consistently year over year for a year. Under tax, most items are declining balance. There are some straight line classes of assets. But when you calculate the CCA that's allowed, that's your maximum allowed, and there's no minimum. So you can choose from 0 up to the maximum CCA to claim in a taxation year, and consistency is not required. So this does create some significant timing differences when you compare your UCC versus your net book value of your assets. All right, as we move on to dispositions, under accounting, your proceeds less your net book value will determine a gain or a loss, and you do track that by individual asset in most situations. However, under tax, you have to look at the lesser of the capital cost or the proceeds of disposition from class. Once you've done that, then that'll determine whether there's a recapture terminal loss or capital gain associated with that transaction. There's a little more detail on page 201 in the textbook, and I'll walk through some examples in our live class together as well. All right, when it comes to additions to the capital cost, typically the addition or the asset being added needs to be in place to help produce income from business property for that organization. And the capital cost typically means the full cost to the taxpayer, which could include freight, installation, non-refundable taxes, legal, or other accounting costs incurred in order to acquire the property. When you're looking at the capitalized interest, you can make a decision on whether you want to include it or not. And if you borrow money to acquire that depreciable property, you can add it to the capital cost. Typically, it's in lieu of deducting any interest in the current tax year, and will usually be an undesirable choice because typically your interest is higher at the beginning. So therefore, if you record it as an interest expense, you can record it all versus as a CCA over the life of the assets, typically at a much lower pace or slower pace than it would be otherwise. Some other general rules to consider are if an organization receives some government assistance, such as a grant to help offset the cost of the asset, they are deducted to determine a net capital cost added to the organization. When we talk about non-arm's length acquisitions, it has to do with transfers of the depreciable property between persons that don't deal at arm's length and that are not made at fair market value. So this may result in the capital cost of the asset not being equal to the amount of consideration given for the asset, and there's more details in Chapter 9 later on. When it comes to taxes, typically HST is paid on depreciable asset acquisitions, and sometimes they're refunded as input tax credits, but if there's a portion that are not, you would include that as part of the capital cost to be amortized over the life of the asset. Some of the other questions you need to ask yourself is the item that you're considering to capitalize or not, is it considered a current expense versus an improvement where it's added to the class? So does it provide a long-lasting benefit? Will it improve the asset, or does it just maintain it, such as painting the exterior of a building versus maybe putting up a new brick wall versus the old siding that might be in place? And last thing is, does it add to an existing property, or does it create a separate asset? And there's a little more detail on page 204 if you require, and it gives you some examples to consider. Another consideration for additions is whether the asset is available for use. In some cases, you have a right or a requirement to defer CCA for up to 2 years, or until that structure or building is considered available for income-producing use. So you need to look through some considerations. When's it going to be first used by the taxpayer? It has to be up to the second taxation year after such time the property was acquired. Is it a public company? Typically then the amortization is recorded on the property based on GAAP. And if it's vehicles, it's based on when did you acquire the license for that vehicle. For buildings, a couple extra rules are in place, or considerations are in place. Where is the space substantially used, where it's 90% or more, or have you owned that building for at least 2 years, and then you have to start amortizing it accordingly. An important consideration is making sure you have the assets put in the proper class. Appendix on page 233 indicates the list of various classes as provided by the Canada Revenue Agency for income tax purposes. And as you can see from the list, the CCA that's allowed ranges drastically from 4% up to 100%. So you want to make sure you have the proper class assigned to those assets. Another consideration is when you have real property, you have to make sure that the land portion of the property is separated from the building component, because land is not depreciable for tax purposes. As mentioned earlier and throughout this chapter, is that there are many different classes, and some of which, or the most of which, being declining balance, and some straight line classes, which will focus typically on class 13 and 14. The other considerations to make are where half-year rules may still be in force, or where the accelerated investment incentive, where you have the ability to take more CCA in the first year of the owned asset. The other consideration, and these are all explained on page 207 a little bit further, is where you have a short fiscal period, in the fact that when you add an asset to a class and it's only used for a portion of the year, that you must be reduced to the appropriate fraction of the year. So if you only own the asset for 6 months, you would take a half of that first year's CCA. Another thing to consider is if you have separate businesses. So if you a car dealership versus a grocery store, you'll have separate Class 8 balances. Another consideration is cars, where there's a cost of over $30,000. There's a separate class than the cars that are under $30,000. There's no recapture, there's no terminal loss, and there's only half a year of CCA in the year of disposition of any cars within that class. Some other separate classes to consider are rental properties with a cost greater than $50,000, which it's hard to find a rental property under that now. New non-residential buildings, and then certain Class 8 assets such as photocopiers, telephone systems, and other assets with short economic lives. And then also non-residential buildings. The next 14 slides or so talk about just at a high level what those common classes are. If you want to get a little more detail around them, they're on page 207 to 210 in the textbook. So let me start right with Class 1B in buildings. Actually this on this slide, we'll move on to the next class in a moment. So buildings acquired after 1987 have a 4% declining balance, but they must be used in certain ranges for manufacturing and processing, etc., whether they apply to that asset or not. Class 3 is for buildings purchased before 1988, and it's a 5% declining balance class versus a 4%. And again, it's just like Class 1 for rental properties. Separate classes were required for each rental building with a cost of $50,000 or more. These classes do include breakwaters, docks, windmills, wharfs, telephone poles, and things like that as well. Class 8 is a catch-all for many things. It's a 20% declining balance class. It includes most machinery, equipment, kilns, tanks, vats, advertising posters, bulletin boards, other furniture that's not covered in other classes. And later on in the chapter we'll talk about individual photocopiers, fax machines, telephone equipment, and etc., which will be a Class 8, but it will be a separate item in Class 8 as based on the election of that tax paper. Class 10 is a category for vehicles at a 30% declining balance. It's for vehicles with a cost of less than $30,000. And after March 19, 2019, if you had a zero emission vehicle, so something that plugged in or electrical, that kind of stuff, they added a new class 54. Class 10.1 is for vehicles greater than $30,000 in value. It's a 30% declining balance, just like Class 10. Except there's a maximum amount of $30,000 being allowed to be capitalized. Every vehicle in this class has to be a separate class 10.1. There's no recapture. However, you're allowed to claim half a year CCA in the year of disposition. Class 12 is for tools, computer software, dishes, books, etc. And all of these items in this class are 100% declining balance. And the half-year rule may or may not apply depending on the situation. Class 13, as we mentioned earlier, is one of these straight-line classes. It's for leasehold improvements, and it's always amortized over the lease term plus one renewal. So if you had a lease that's, say, a 5-year lease plus another 5-year renewal, you would amortize those items over a 10-year period. The range for these leasehold improvements must be between 5 and no more than 40 years. And each expenditure has to be amortized separately within the class. Class 14 are for limited life intangibles. It's straight line over the legal life, and it's pro rata based on days. There's no half year at the beginning or the end. It's based on the actual number of days that asset was owned and used by the organization. It's important to note that patents are included in a different class, being 44. Class 14.1 includes goodwill, unlimited life intangibles, and then a carryover of the December 31st, 2016 CEC balances that we talked about. They have a 5% declining balance, CCA. There are options or situations where you have a recapture and capital gains, and there'll be a more detailed discussion later on after the short fiscal period material. Now, when we're talking about manufacturing and processing assets, there are actually 3 different classes to consider based on the time period when those assets were added. Class 43 being the oldest at 30% declining balance, Class 29 being a 50% straight line for a period of 07 to 2016, or before 2016, and then 16 to current is Class 53 being a 50% declining balance. So obviously Class 43 and 29 there'll be no new additions because those asset classes have been wrapped up. Class 44 is for patents that were acquired after April 26, 1993, 25% declining balance. However, you can choose to use Class 14 if it's near the end of the patent's life. Class 50 is for computer hardware and system software at a 55% declining balance. It's typically for items acquired after January 31st, 2011, and therefore the items go to this Class 50. Declining balance, 55% rate. And the final class that we'll cover in this section is 54 for zero emission vehicles. It was just added about 2 years ago through the federal budget and announced in March of 2019. It's for zero emission vehicles that would typically be in Class 10 or 10.1, but this class is allowed a 100% write-off in the year that's acquired. Say up until 2018, there was a half-year rule applied in most cases, with a couple of exceptions, where the CCA for assets acquired in the year was reduced by 50%, just to kind of average out the fact that you may buy assets at varying time throughout the year. And then we'll move on from where we had talked about half-year rules, and then there was the introduction of the accelerated investment incentive provisions, which came through the economic statement 2.5 years ago, November of 2018, where actually you can take additional CCA based on a grossed up amount for any additions in that year for the many asset classes. So under the accelerated investment incentive, it applies to newly acquired eligible assets, which are mostly depreciable. There is no longer a half-year rule, and it adds 50% to the cost for the purposes of determining the first year CCA. And there's a little table on page 212 that walks through an example of before 2018 or after 2018, and it indicates or suggests demonstrates to you that under the old rules you would have only had $10,000 in CCA in the first year, versus under the new rules under the accelerated program you would have $30,000 in CCA. It is important to note that the CCA over the life of the asset will not be any different. It just increases the amount able to be taken in the first year of acquisition for those assets. And eligible assets are for anything acquired after November 2018. In most cases, a couple of exceptions where if it was previously owned by the taxpayer or if it was acquired on a rollover basis. However, the asset does not necessarily have to be new, so it could be a used asset that the organization bought for purposes of producing income that would qualify for this incentive. For declining balance classes, it might be helpful to actually take a look at page 213. There's a table there that talks about a 2-year rolling period for declining balance assets, where you have a UCC of $250,000 in both cases, one of which uses the half-year rule, the old rules, and the right-hand column uses the accelerated investment incentive calculation, and it identifies that yes, you can take more CCA up front, 54 versus 62,000 in year 1, but it will eventually decline and offset, just like I commented earlier, where the CCA taken over the life of the assets will balance out over time. For class 12 under the accelerated investment incentive straight line class, it was determined by the government that this class would not be applicable for the accelerated investment incentive, largely because most of the assets in that class are written off at 100% in the year of acquisition anyway, with some exceptions, specifically an exception being computer software, where it's limited to a 50% write-off in the year of acquisition. The government did not change that. Class 13 being a straight line class, it is available, the accelerated investment incentive, to be applied. And because it's straight line, the first year would have a 50% increase in the amount of CCA able to be taken. However, in the final year of that leasehold improvement, it would be reduced by that 50%. So again, over the life of that asset, that leasehold improvement, the CCA would be the same. You're just taking basically half of the final year and writing it off in the first year. If you want to see a little additional examples on page 214. Class 53 being another straight line class, the accelerated investment incentive does apply, and the net result of the calculation is it's 100% write-off in the year of acquisition. And again, for a walkthrough example, you can see that on page 215. I'm moving on to zero emission vehicles. In order to be an eligible vehicle, it must have been a vehicle that would have normally been included in class 10, 10.1, or 16. It must be fully electric or one of the other parameters where it's considered nearly fully electric. And it must not have been used for any other purpose before it was acquired by the taxpayer. Alright, when we're talking about these zero emission vehicles, there are class 54 and 55. We can write off 100% in the year of acquisition. Class 54 only gets the 100% on the first $55,000 though. In the text, there's a little bit of additional information that from 2019 to 2023, these two classes will be eligible for 100% write-off in the year of acquisition, and it'll be reduced later on in 2024 and 2025 to 75%, and then dropping subsequently to 55% in 26 and 27, and then in 2028, it will no longer be available, these two classes. The government implemented these to help encourage some of the migration and investment into zero-emission vehicles by allowing write-offs at a faster pace. Therefore, it's helping have a lesser net impact to the organization. Another consideration we mentioned earlier was about short fiscal periods. Under CCA rules, it's pro rata based on the number of days. So if you used it for, say, 7 months at 210 days out of 365, you would do the calculation accordingly to determine your CCA. It only applies in the first and last year of operation. However, it does apply when there are deemed year ends. So a brief conversation about Class 14.1, talking about intangible assets outside of goodwill, just to give you some other examples of what additions could be considered. Customer lists, for example, unlimited life franchises, trademarks, licenses to use various information, incorporation costs greater than $3,000, because anything under can be deducted against business income in the year incurred. Appraisal costs, reorg costs, government rights, and some payments under non-competition agreements. Now, specifically for Class 14.1 around goodwill, it's largely related to the acquisition of business and that acquisition cost where it exceeded the value of the net assets of the organization being acquired. You'll track the capital costs of those individual acquisitions. Okay, and it's only if operated as a separate business. So if you buy an arm of business and it has a net asset value greater less than what you paid for it, it'll create goodwill. And every business should, in theory, have a goodwill account. However, there's only one goodwill account for a specific business. So multiple acquisitions can go into a single goodwill account with a single capital cost. However, it's important when there's a disposition to understand what goodwill or what portion of the goodwill was acquired to what line of business or portion of the operations. One of the tax planning considerations when it comes to CCA is when you calculate CCA, that determines what your maximum allowable is, not what you have to take. So in years that you don't need all the CCA to get your net income to zero, you can actually make a decision as far as what classes you take CCA on versus not. And in the situation on the screen here, it talks about an organization has a $10,000 net income before deduction of CCA. And they have these couple of classes 1 and 10 of potential maximum CCA for the year. In this situation, your best bet would be to take your maximum CCA on class 1 to be $10,000 because the maximum that will be allowed in the following year would be higher than if you did it on the inverse. So you always want to carry forward the most available CCA into future years. And now for dispositions on capital assets, it's the general rule is the lesser of proceeds of disposition and the capital cost of the asset. So in the two situations where the POD is less than the capital cost, you would deduct the POD from the UCC. But where it exceeds the capital cost, you would deduct the capital cost of that initial capital asset purchase from the UCC. And any excess is a capital gain. Now where there's a capital gain, where there's a proceeds of disposition exceeds the capital cost, it'll generally be accompanied by a recapture. However, just to be considered, there is never a possibility of capital loss on depreciable assets. Okay, so it's just the way the formula works against the UCC of that said class. However, for all of this to work, the organization or the taxpayer must keep track of the capital costs for individual assets. We're going to walk through a couple of examples now, and this one is a recapture. We have two assets, class 8, 50 grand cost each. Total CCA taken in the years prior, 63,000, leaving a UCC of 36 and change. And we sold one of the assets for $40,000. So if you look at our balance of the UCC being 36 and change, take away the 40,000, you have a negative UCC of 3136, which you cannot have. What'll happen then is you'll record this as a recapture of CCA for 3,136 to restore the UCC back to a nil balance. Therefore, you would have no CCA in future years related to the other asset that's remaining. Another example is where we have a recapture with a capital gain, where two assets in the class both cost 50, so it's the same starting example, UCC of 36,864. We sold one asset for 60,000, which is greater than the capital cost. So for the UCC calculation, we'll have a 36,864 UCC, take away the capital cost of 50,000 is a 13,136 recapture. And then the capital gain is calculated as the $60,000 sales price less the capital cost of $50,000, which is a $10,000 capital gain. 50% of capital gains are taxable, so there'll be a taxable amount of $5,000 for that organization. The last example that we'll walk through is a terminal loss, where we have the same assets and we sold both of them for 20 grand in total. So we have the 36,864 UCC less the $20,000 proceed of disposition, leaving a UCC of 16,864. However, in this example, we have no assets left in the class. Since there are no assets left in the class, we now have a fully deductible terminal loss. It's not a capital loss, it's a terminal loss. For class 54, there is a problem when you have assets that far exceed the maximum CCA allowed, being 55,000 in this example. And the textbook walks through a situation on page 224, 225, where what if the organization bought an asset for 150,000? Due to the $55,000 limit, they took CCA of $55,000 in the first year. But then a year later, they turned around and sold that asset for $110,000. So under the previous rules, they would have a recapture of $110,000 because the UCC is 0. However, because this is a known consideration, the Income Tax Act, Section 13, talks about a calculation which is the deemed proceeds of disposition, where it looks at the actual proceeds times the $55,000 maximum divided by the original capital cost of the asset. So in this situation, it'd be 110,000 proceeds times 55 divided by the 150 original amount, being 40,333 would be the proper recapture in this situation. Now, when it comes to dispositions on class 14.1, it's typically where goodwill is all put into a single capital value, and this is assuming that the goodwill acquired is with a business that will be absorbed into general operations. If a business is acquired that will be operated separately, the goodwill will be allocated to a separate class 14.1. And in that situation, there could be a terminal loss if the business sold off and closed off or terminated that business line that they originally acquired. This is a sample schedule of what the CCA calculation would look like. So you may want to create a little template or have something in your back pocket that will follow this, because you'll do this calculation in some of your examples. Yeah, you may have recalled earlier we talked about some eligible assets that could consider a separate class election, specifically photocopiers, communications equipment, or other software. And the reason being the rate of change in technology areas typically far exceeds the rate of CCA allowed within these categories. So by tracking them as a separate class, you're able to take terminal losses at the proper time once you dispose of those assets or that computer software. The next couple slides will discuss this example of where there is a separate class or no separate class, where we bought a $25,000 photocopier, added to class A, which has a balance of $225,000, and after 2 years we sold it for $5,000. In the first example, we have no separate class 8, so far we simply just subtract $5,000 being the proceeds of disposition, being less than the capital cost, from the class 8 UCC, and there's no immediate tax effects. If we elected for a separate class 8, the UCC for that specific asset would be $17,500, being the original $25,000 less the first half year amount of $2,500 less the second year amount of $5,000. The terminal loss would be $12,500, being the UCC of $17,500 less the proceeds of disposition of $5,000. So there'd be a terminal loss, which would create a tax reduction for this organization. One area that's given some special consideration is the change in use of automobiles. So an example could be you have a vehicle that's used for both personal and business, and the percentage each year changes. So what the special rule does is it allows you to calculate the capital cost allowance based on 100% usage each year, but you're only allowed to deduct for tax purposes the percentage used for generating business income. So if the asset is declining in value, your UCC, at 100% rate, but you're only deducting tax based on the actual applicable utilization on each year. A couple other situations which are discussed in Chapter 8 talk about the sale of land and buildings and other dispositions, whether voluntary or not. So that wraps up some of the verbal walkthrough of the Chapter 5, and I hope you found this helpful to some degree. And if you want more details, you can either refer to the text, refer to some examples, or we'll walk through some specific examples in class together.